Hi, I'm Jeff Hupman with the Hupman Group at Keller Williams Realty, and this is Padraic with United Community Bank, Patrick Robertson. And I wanted to ask you, Patrick, some questions about the loan process when buying a house, especially in regards to folks that are buying a house for the first time that maybe aren't as comfortable with the process, haven't been through it before. So from an overview standpoint, what's the most important thing for a first-time homeowner to know about the mortgage process?
Well, the first-time homeowner, it's normally the clientele that we see, that this is the largest transaction that they have had in their entire life.
Yeah.
You know, they're purchasing a house, they're taking out a large obligation. So I would say that the most important thing is when they sit down with the loan officer to make sure they're comfortable with, one, the upfront cost that's going to be incurred at closing, both the down payment and closing cost.
Right.
And secondly, the monthly payment. They don't want to make themselves house poor, so make sure they're comfortable with all the numbers.
So we run into a lot of folks that really aren't sure exactly how all those numbers work. So how would somebody that's never gone through this before know what to expect as far as how much closing costs are going to be, how much prepaids are going to be? How would they get that information?
When they sit down with a loan officer for the first time, it'll be a long conversation. All right, the loan officer is going to talk with you. They're going to find out exactly what you're looking for, what your time frame is, ask you for a lot of personal financial information. One, to see what they can qualify you for and what would be the best fit, and then they'll produce a loan illustration for you. That illustration should go over what you should expect for estimated costs regarding your closing costs, which are going to be your bank fees, your attorney's fees, your taxes, and also your prepaid items, which are mostly your insurance, the upfront mortgage insurance premiums, that sort of thing. And this will all be itemized out on a sheet, so they can go line by line with you and answer any questions that you might have as you come across them. Good
deal. So it sounds like if somebody tells a homeowner or a soon-to-be homeowner, oh yeah, it's going to be about 2% or 4% of the cost of the house, that's probably a little bit too loose. They really need to sit down with somebody if they want to have a good idea of what it's actually going to cost.
Yeah, absolutely. And knowing what area you want to buy in also plays a big part on that. When you work with a local loan officer, they're going to know what the going cost is for insurance in that area, what the city or county millage rate is to estimate taxes, so they can really drill down and give you a specific number.
Right. And I will vouch for you in that regards. Our experience has been that folks that live in the area tend to know more about how the mortgages work in that area, what programs are available, and that makes a lot of sense to us as well. So tell me a little bit about how credit affects getting a mortgage and mortgage rates.
Absolutely. Credit is not the end-all be-all factor of a mortgage loan, but it is a very large determining factor. Most banks and loan programs have minimum credit score requirements that have to be met, and those do vary between bank and mortgage lender. It does affect your interest rate, but mortgages now, they go off the 10-year Treasury note. It's very, I would say, regulated industry. So even if your credit isn't the best credit, your interest rate's not going to be so far out of line. The subprime market is no longer there, so you're not going to have a 2 or 3 point difference than someone that has best credit. Gotcha. It might be a half a point difference.
Gotcha. Okay, so the rates can fluctuate a little bit depending on your credit, but as long as you have some credit built up, then you have a chance at being able to at least get a loan. So
I would recommend don't discount yourself.
Okay.
Sit down with a professional, let them run the numbers and look at your credit report with you. I've sat down with many, especially first-time home buyers, that think they don't have very good credit, just because they haven't used credit that much. But it turns out that they're actually very well qualified.
Good. That's a good conversation to have, huh?
Absolutely.
Cool. So can you give me an idea of how much money you need to have saved up to start considering buying a house? Is there a certain amount, or does it vary just case by case?
It really does vary case by case. What your comfort level is. Some people like to have more reserves built up. A nest egg, a savings account. Some folks, that's not necessarily important to them. The different loan programs that we would discuss with a potential buyer have different down payment requirements.
Okay.
Honestly, you can purchase in some areas of the country and get a USDA loan and have no down payment.
Right. That's pretty awesome.
You know, yeah, that's definitely an avenue for some folks. Other people want to put down at least 20% to avoid any mortgage insurance costs.
Right.
So you know, it really goes back to the individual and what their comfort level is.
Right, and with you mentioned USDA, and I know also there are VA loans, so there are certain types of loans that have no money down, and some that have only a few % down, but each of those has different types of guidelines, is that right? And different types of folks that can qualify for those?
Yeah, absolutely. And again, this is where when you have that initial conversation between a buyer and a mortgage loan officer, they're going to discuss these things and see what's available for you specifically. And one of the things to mention is there's also down payment assistance programs. So if you are a potential buyer and you've got good credit and you've got pretty good income, but you just don't have much saved up because you're really just getting into the workforce, there's some programs out there that could possibly help you and come with that down payment piece of it for you.
Gotcha. So it's possible, depending on the type of program, that you could purchase a house with very little or almost no money saved up. Is that right?
Absolutely.
Okay. So here's another question we get a lot is, what happens if somebody's credit score changes between the time they first sit down with a loan officer and the time that they actually close on the house? Can that create issues?
Yes, it can. But there's a couple of things to note. One, when your credit report is pulled, it's good for 120 days in most cases. So as long as you're pre-qualified with the lender and close within 120 days, they're going to use that same report in most cases.
Gotcha.
One thing that is now done is mortgage companies do what they call credit monitoring. So once you initially apply for a loan and actually start an application, have a property under contract, from the date that your credit report was initially pulled, if any other company has made an inquiry on your credit, the bank will get a report of that, and we'll have to verify whether any new lines of credit or new loans have been taken out, new credit cards. So it's very important that when you do sit down with the loan officer and pre-qualify, that you don't do anything that has to do with your social security number to a creditor until after you've closed on your home. No credit cards, no going out buying furniture, don't go buy the brand new car, you know, while you're in that process.
So let's just play it out here. So if somebody doesn't know better, they come and sit down with the loan officer, they start the process going with putting a house under contract, and then a week before they close on the house, they go out and buy a new car. I mean, how can that affect things? What could happen?
Well, if they buy a new car and now it's a new obligation that they have on their credit, the loan officer is now going to have to count that new payment in their debt ratio number, and that might put them over the maximum allowable debt ratio for that type of loan that they've applied for. And at that point, the loan would be denied.
Yeah. So it could be a big deal.
Could be a big deal.
Okay. Good. And I think that really covers a lot of the basic overview type questions I have. I appreciate you sharing with us, Padraic. If you have any questions for us, you can find us at hupmangroup.com, HUPMANGROUP.com. How can they find you, Padraic?
Best way is probably email. It's Padraic, PADRAIC _Robertson, ROBERTSON @UCBI.com.
Thanks for listening.